Bank of America CEO Brian Moynihan telling us last hour his thoughts on the current state of the economy. Take a listen.
The economy is slowing down. They're guiding it down. Will be a soft landing. Our economists think it'll be a recession, but a mild recession. And unemployment moves up, in the mid fours, but that used to be full employment, honestly. So it's not quite the disruptive thing. Now, will that have an impact on all the economy, and will that ultimately have an impact on financial services? Of course it does. But the reality is that it's really going to come down to if people are employed and people are spending a little bit more, companies will have revenue and they'll be okay.
So as the market seems to be pricing in a skip on hiking rates at this week's meeting, our next guest is expecting a deepening profits recession and tightening liquidity. He's focusing on high quality and less economically sensitive parts of the market. Joining us now is Dan Suzuki, Deputy Chief Investment Officer with Richard Bernstein Advisors. Not going into venture capital like CalPERS is, Dan.
No, Kelly, I think this is not the time to pedal to the metal on risk here. I mean, if profits were surging and liquidity were improving and you had a cheap market, that's one thing. But clearly, you have aspects of opposite on all those three fronts. So I think this is the time in markets where, you don't need to be under your desk in fetal position, but you do need to be a little bit cautious here.
But how do you wake up every day and look at NVIDIA and look at Tesla and look at these mega caps and not go, why not just sit there and take collect the money and not have to hear angst from clients if you are?
Well, Kelly, that's just human psychology, right? People want to chase the thing that's gone up. But, if you stay focused on the fundamentals, history shows that that's a bad idea. Momentum works until it doesn't. And so I think the only way to continue to sort of compound, outperformance over the long term is to stick to the underlying fundamentals. And the underlying fundamentals here, unfortunately, you have a profit cycle that's weakening, you have liquidity that's tightening, and you have a market that's trading at 19 times earnings, with big parts of it trading, basically 25 to 30 times. So I think that begs some risk, at least with regards to the overall market. I think if you want to dig underneath the surface and avoid those areas of froth, there's tons of opportunity out there. But then again, it comes down to your time horizon.
Well, let's get to some of those, because we just heard Tony Sacconaghi say that during these periods where there's high market concentration in the ensuing 6 months, those stocks that were part of that concentration tend to underperform the overall market. Which kinds of stocks will overperform the market over the next 6 months? Those that haven't taken part so far.
Well, Tyler, I think you just answered it right there. I think that, either way the economy goes, those stocks are probably not going to be the leadership. Now, I think the economy can go two directions from here. It can get worse or it can get better. Now, in the scenario where it gets worse, I think that's where the companies with less economic sensitivity that trade at much cheaper valuations are going to hold up a lot better, than, the handful of stocks that are driving performance today. But on the other side, where things get better, you've seen it just over the last couple of weeks. If there's a little bit of optimism around growth, there's tons of stocks out there trading at basically, close to single-digit multiples, but they're going to see their earnings accelerate much, much faster than these expensive parts of the market. So why would you pay up for these areas when, there's going to be plenty of growth in that scenario?
So let me ask you to get a little more specific. Let's, under scenario number one, where things get a little bit worse, you want what kinds of shares, what sectors or types in terms of large cap versus small cap? And in that scenario where things might get a little bit better, there you seem to be saying there's still growth areas of the market that are not these overplayed ones.
Sure. So, Tyler, in the scenario that things get worse, you want the companies that are going to have this resilient earnings stream, that more resilient revenue stream. And I think classically, from a sector perspective, that's healthcare, staples, utilities, because you're still going to get sick. You're still going to feed your family. You're still going to heat your home. But also you have to look beyond that. From an asset class perspective, I think Treasurys actually look very attractive here, particularly on the long end of the curve. Having a little bit of gold in the portfolio. There's a lot of ways to get defense in the portfolio. But then, in the optimistic scenario, everything, small caps, value, cyclical stocks are incredibly cheap and out of favor here.
All right.